think that a lot of what you hear in investing media and from different personalities is completely wrong. And I think that there's too much worry in the markets overall. And I think that the investing philosophy of most people that you hear from is very flawed. Now, what do I mean by this? I mean that a lot of the times the companies that get the most attention, whether it be a Mag 7 company or a meme stock company or cryptocurrencies, people have a certain interest in talking about these assets. And it's just because that they have a lot of popularity right now that people are talking about them. And I think this is the wrong way to actually invest. I think that when you're investing, you need to look at it from the standpoint of owning the entire business or owning a farm. You want something that is going to increase reliably over time and have easy pathways to growth. And when I talk about that with the context of a farm, it's very easy to really kind of understand and break down. When a farm makes a certain crop and it produces that crop and it sells it, very often, if you're running a successful farm, you're making some kind of income. And with that income, a lot of the times it's very obvious what that farm is going to do with that income. They're going to either buy more land, buy more livestock, or pay off debts. This is very common, or they're going to profit that money, which in this case could be very similar to when a company pays a dividend. Now, with the buying more land, this could mean a myriad of different things. And if I'm looking at my own account, this could be when Salesforce improves its product. This could be when Vici buys a new property that increases its cash flow. Ultimately, you want businesses that operate in this way and that are very reliably going to increase the amount of revenue that they're pulling in and the amount of net income that they're able to return to shareholders and have very reliable sources of growth over the very long term. Because when you buy into a farm, the idea isn't to buy the farm and sell it to someone else for more in a week. The idea of owning a farm or any asset that isn't a stock seems to be that you would buy it and collect good cash flow over time. I think that you really need to look at stocks and companies the same way you look at farms or some of these more traditional assets. This is why I think gold is a bad investment, because if you invest the same amount of money into a company like Waste Management or a gold bar, so let's say we have the share price of Waste Management versus whatever the current price of gold is, and you put an equivalent amount of money in, you know that Waste Management is working hard to increase the amount of revenue they're making, have some mergers and acquisitions, and really stretch that dollar because they're a company that's producing something. In the same way that if you have a farm and you pay a certain amount of money for it, they're going to be using the excess money from the livestock or the actual crop that they're selling and that net income to buy more land or produce more of that commodity. Whereas the gold will just sit there. There can be an argument that it's even losing value because we're pulling more gold out of the ground and we're finding new ways to do that. And that's the same way with these coins that have no utility. You could at least argue that gold serves a function of a store of value, whether that's with jewelry or with computer components or various things that require this rare metal. But when we're looking at something like a meme coin, it doesn't create anything. You can print an unlimited amount of it, and oftentimes you're only buying into it because you think that you can sell it to someone else for more money. This idea is not something that's necessarily even new. Trading different things that are worthless, this actually started, or the first recorded instance of this was the tulip mania that happened in the Netherlands, where the wealthy had tulips as a sign of status, and they would trade these tulips for increasingly more and more and more. And it eventually got to the point where the bubble burst, and the people that had bought these tulips were in the same situation that a lot of meme stock holders end up getting into. This really just highlights stupid greed. And the reason for that is that these tulips were not producing anything. Just like these meme coins were not producing anything, just like NFTs don't produce anything. It'll always come back to earth eventually. I mean, eventually, when something's hyped up, whether that's because you believe in the CEO, whether that's because you think it's really funny, or you think you could make more money on it because someone you know made a lot of money on it, or you see other people online making a lot of money off of it. Fundamentally, if it's an asset that's not producing a product that is useful to society, it's not going to end up well. It's not going to retain any sort of value. And that's kind of how you have to look at investing. You want stocks that you can buy into and reliably know that over time they can increase their cash flows, they can increase their revenue, and they can be in a better place than they were 10 years ago. And I think that that's how I've built my own personal portfolio. And each company kind of does this in a different way. So if we look at Vici, you can see that the properties that they own on the Las Vegas Strip are invaluable. You really can't just build a new Venetian. You really can't build any of the casinos that they own from scratch today. It would take many, many years, and you're not going to get the same location. So there's really a real intrinsic value there. And the way that they're able to increase that value in the same way that a farmer would increase the value of his farm is that, for one, they pay a good dividend, and for two, they take their excess retained earnings that weren't used to, give back to the shareholders in the form of a dividend, and they're either buying more properties or paying off debt, which increases the value of the company. With a software company like Salesforce, you have a very difficult thing for existing companies to get out of. And you have a very high quality service and a company that's very focused on that customer relationship management service. And so what ends up happening is customers will let Salesforce run their CRM because it's the main thing that they do. And with that initial capital that they get for their superior software, they're able to improve the software more. And then more companies are wanting to join on. And then what continues to happen is they get more money and they're able to make their product better. So they're producing a real thing. And then eventually they're able to branch into other things like their Agentforce software, which is being used essentially to increase productivity in lower paid workers with specifically in terms of customer relationship things. So it's not like the typical type of chatbots that you're getting. It's a whole new type of AI software that's able to solve complex problems for a cheaper price than paying more employees that do that same customer service role. And I have a lot of other companies kind of similar to this. I mean, if you look at Waste Management, they're able to consistently, organically grow. And because they have a lot of retained earnings, they can make mergers and acquisitions that also make them grow by having new trash lines that synergistically make sense for their own company. And I can't really envision Waste Management as a company making less money in 10 years than they are right now. I mean, it just seems like very logical that Waste Management is going to be the type of amazing business that continues to grow over time. I can't say the same for a lot of other companies in the S&P. And the way that I chose Waste Management or any of the companies in my portfolio is I kind of do a trick that I heard Charlie Munger talk about, because he was obviously the co-chairman of Berkshire Hathaway before he died, and he was a meteorologist during World War II. And one of the things he talked about that he learned as a meteorologist is that you had to think of the worst case scenario and how it would happen. When I look at companies to invest in, I think of all of the ways that the company could fall short and all of the problems that could happen with the company. It's kind of like a risk mitigation way of looking at companies. And so I look at all the ways that a company could fall short and a company could lose money and the worst case scenario that could happen for a company. And companies that have less of those tend to do better. So I have a very pessimistic approach when I'm looking at stocks. And you can see that in my stock analysis videos. I will very rarely say that I think a company is good enough to add to my own portfolio. And you don't see a lot of that on Wall Street. You see different personalities pumping different stocks that they have a vested interest in because they think that it's the cool stock of the week. When I decided to make this channel, I made it to try to keep my skills in being able to value companies and give my perspective on why I thought certain companies were weak or why I thought certain companies were strong in the long term. And I think when you have a very nuanced, pessimistic approach on buying stocks that's very long term, I think that that's the correct way to invest. Because if you're very hard on companies and you're really looking at them from a long-term perspective, you're able to make better decisions because you're more stingy with what you would actually commit your money to. Because ultimately, it doesn't matter if you look at a company that you don't fully understand and you don't think necessarily would have the best chance in the next 10 years, and you're wrong about that. You don't lose any money because you haven't put any money into it. But it's the companies that you think are really going to perform well in the long term that don't, that are really going to make you lose money over time because it's something that you committed your money to already and you were wrong about. And that's how you have to look at investing. You shouldn't look at short-term things that people are pumping on various different programs. And you really, if you're a long-term investor and you're investing in stocks, you should be buying into companies that you believe are undervalued for the services and the place that they're going to be in the future. And you should be holding on to those companies through very poor times. And you should be buying more. You should really be buying more of those companies going forward because the value or the amount of shares you can get for your dollar is higher when the company sinks in valuation. And so if you hold the same thesis that the company is going to be worth a lot more and whatever event that has caused it to drop does not affect this thesis, then you should be more willing to expose yourself to buy that particular asset. And so when you're looking for companies, you want to find companies that you believe are undervalued for what they are producing and that you want to look at just like a farm. You want to find a farm that produces a good crop pretty consistently and is able to grow the amount of production that it's having because fundamentally, these companies are very similar to a farm or to a rental property or to any other type of asset that you are buying into because you want something that is going to be in a better place than it was 10 years ago, just like if you were working on a farm. And that's kind of my investing philosophy. I look for companies that in the long term, I do not see being displaced and I see in much better positions than they are today. Because ultimately, I think that's the thing that matters even more than the valuation. Not that the valuation doesn't matter, because I do see Waste Management continuing to grow as a company and being strong into the future. But I just think that tech stocks have been really oversold, so I'm getting more growth for my dollar there right now. So there, it is kind of nuanced, and I do want to also hold those tech stocks for the long term because I think that they provide an incredible amount of value for one in their cash flow and their growth and to society, and I don't think it's very likely that a lot of them are going to be worth less going into the future, especially Amazon, which I'm a holder of, Salesforce, again, which I've talked about kind of at length now, Meta, which I believe is very important in our lives. And I really see, specifically with Meta, I think that their ability to show their users more targeted ads that are just better and their ability to grow their user base and cut their costs and continue to finance more efficiently is going to cause Meta to have more value for its shareholders into the future. So that's kind of my approach to investing. I want companies that in the next 10 years are very likely to be worth more than they're worth now. And I don't really care about the short-term things that are happening unless they really, really affect the company that I'm investing in. And when I see my wonderful companies that I've done the research and done the work on the DCF model valuation and thought through the actual business model of the company go down, I'm going to be buying more of those. And that's just how I like to think about stocks. I don't want to own anything because it's trendy or because a certain person thinks it's good or because my best friend made a lot of money trading it. I want to own assets that produce real cash flow and are going to be in a better place into the future. Let me know what you guys thought about this video. I think that there's a lot of really bad information on the internet overall about investing, and I think that not enough people have a really long-term, nuanced approach to investing, specifically because it takes a lot of time and a lot of patience, and it's better to be safe, but a lot of people, again, don't want to spend the time that it takes to get those real returns that are very material, and it's very tempting to chase something that's trendy. But let me know what you guys think about my thoughts. I want to hear your thoughts as well on what your investing philosophy is and what type of assets you look, or what type of qualities you look for in a company, and what type of things matter to you, because obviously for a more mature investor, a dividend yield is going to matter more, whereas for an investor with more time and less money, they're going to want more growth in the free cash flow and in the revenue. Please hit the subscribe button if you made it this far. I really appreciate all of you guys. Thank you so much for watching.